Hello investors and traders. Today we will be discussing a winning gap up, gap down strategy. Imagine a stock basing going nowhere for 6-7 months and then suddenly out of nowhere it jumps up 10% before the market even opens. This is called a gap up. It also works in the other direction. Imagine the stock is hitting all-time highs and continuing higher and higher, and then suddenly you have a huge down day before the market even opens. This is called a gap down. We will have a complete strategy how to play a winning gap up, gap down strategy. In volatile markets, traders can benefit from large jumps in asset prices if they can be turned into opportunities. Gaps are areas on the chart where the price of a stock or another financial instrument moves sharply up or down with little or no trading in between. As a result, the assets chart shows a gap in the normal price pattern. The enterprising trader can interpret and exploit all these gaps for profit. The video will help you understand how and why gaps occur and how you can use them to make profitable trades. Some key takeaways before we get started. Gaps are space in a chart that emerge when the price of the financial instrument significantly changes with little or no trading in between. Gaps occur unexpectedly as the perceived value of the investment changes due to the underlying fundamental or technical factors. Gaps are classified as breakaway, exhaustion, common, or continuous based on when they occur in a price pattern and what they signal. Example of a breakaway gap in the stock market. The chart of Apple, AAPL, below has 3 gaps marked on it. The first comes when the price forms a triangle pattern after a downward. The price then gaps up above the triangle in a high volume and then continues to rally to the upside. This is a breakaway gap associated with earnings announcements. During the ensuing uptrend, the price also experienced some runaway gaps. The first runaway gaps was a series of them were not associated with earnings. The second runaway gap marked on the chart was associated with earnings. These gaps all occurred on high volume. Be classified into 4 groups. Breakaway gaps occur at the end of a price pattern and signals the beginning of a new trend. Exhaustion gaps occur near the end of a price pattern and signals a final attempt to hit new highs or lows. Common gaps cannot be placed in a price pattern. They simply represent an area where the price has gapped. Continuation gaps, also known as runaway gaps, occurs in the middle of a price pattern and signals a rush of buyers or sellers who share a common belief in the underlying stock's future direction. Gap up, gap down strategy combined with volume and RSI. One of the strategies we use is not just a gap up, a break up, gap up, but we combine it, of course, with volume and an RSI. What usually happens a lot of times on a gap up, it gaps up huge and it doesn't run away. It can pull back for 4 or 5 or even 6 days. What is going on? Imagine a gap up, a big investment banking or hedge fund driving up the price. That price can go back down. Most of the time we see it goes down, and that's where the RSI happens. But we want the initial breakout to be on volume. So let's go over Rule 1. Rule 1 for us is follow a top-down approach. Whatever way you're investing, we always look at the big picture. So if we are in a bull market, we're looking for gap ups. If we're in a bear market, we're looking for gap downs. So the first answer of this is, which direction is the market going into? Are we in a bull market or a bear market? During bear markets, we're going to have a lot more gap downs and a lot more breakthrough gap downs and a lot more continuation gap downs. The same thing will be happening for gap ups. So the first thing that we look for is the overall trend of the market with a top-down analysis. For this case study, we will assume the overall market is bullish for the case study. But remember, we could be in a bear market. And if in a bear market, it's the opposite rules I give you here today. Rule 2. Breakout gaps occur at the end of price pattern and signals the beginning of a new trend. We specifically look for a lot of these basing stocks for 6, 7, 8 months. It was basing or it declined and then it based for a month or 2 months. These are ones that the initial breakout will be huge And the continuation of the breakout will be huge. Imagine you held a stock for 9 months and it went down for 9 months straight. You will not be buying even if it's gapped up because you bought it, let's say, at 100 and now it's at 20. And that 20 stayed there for 2 months. That initial breakout on volume is one that we see is a great stock to purchase. We look for the high volume, of course. We look for the huge amount of percentage of breakout. Most people are like, it went up 10% in a day. Why should I buy into it? Well, that 10% was backed by investments, hedge funds, and smart money. Rule 4. What we try to do is, after the initial breakout, it's usually a very high RSI. And then we wait for a pullback on the RSI. Best results followed by a breakaway gap. So after the initial breakout, there'll be continuous breakout gaps in the next 3 months, 6 months, 9 months of this security. During the ensuing uptrend, the price will also experience some runaway gaps. Remember always to protect your profit. This strategy works very good. Test it out, look at it. So again, gap up on a security that has had 6-7 months of declining and then a basing period. This breakout, this gap up, has been on high volume. And then after the initial gap up, we wait for a low RSI, and not a long-term RSI, maybe a 5 to 6 settings on the RSI, just to pull back enough. And this might be anywhere from 3 to 7 days pullback for this security. What is a breakaway gap? A breakaway gap is a term used in technical analysis which identifies a strong price movement through a support or resistance. A gap is the difference between the open price and the prior close price, where no trading activity takes place. The price breaks away from the support or resistance via a gap as opposed to an intraday breakout. Breakaway gaps are often seen early in a trend when the price moves out of a trading range or following a trend reversal. More key takeaways. A breakout gap occurs when the price gaps above resistance or gaps below support. Support or resistance in this case is often associated with a chart pattern such as a trading range, triangle, wedge, or other patterns. Breakaway gaps often occur in a trend and show conviction in the new trend direction. Other gaps types include runaway, exhaustion, and common gaps. Understanding the breakaway gap. A breakaway gap occurs when a price gaps above a support or resistance area like those established during a trading range. When the price breaks out of a well-established trading range via gap, that is a breakaway gap. A breakaway gap could also occur out of another type of chart pattern such as a triangle, wedge, cup, and handle, rounded bottom or top, or head and shoulders pattern. Breakaway gaps are also typically associated with confirming of a new trend. For example, the prior trend may have been down, the price then forms a large cup and handle pattern and then has a breakaway gap to the upside above the handle. This would help confirm that downward is over and the uptrend is underway. The breakaway gap, which shows strong conviction on the part of the buyers, in this case is a piece of evidence that points to further upside in addition to the chart pattern breakout. A breakout chart with larger than average volume or especially high volume shows strong conviction in the gap direction. A volume increase on a breakout gap helps confirm that the price is likely to continue in the breakout direction. If the volume is low on a breakout gap, there is a greater chance of failure. A failed breakout occurs when the price gaps above the resistance or below support but can sustain the price and moves back into prior trading range. Gaps can occur at any time but are highly likely to occur following earnings announcements or other major corporate announcements. Trend and gap cycles. While not every trend has a breakout gap, some trends do have a breakout gap and they are often seen early on in a trend when the prices make a significant move outside of a chart pattern. That said, anytime a significant chart pattern is followed by a gapping breakout, it could be called a breakout gap. As the trend accelerates, it then tends to see another type of gap called the runaway gap. A runaway gap is when the price opens significantly higher than the prior close in an established uptrend. During a downward trend, a runaway gap is when the price opens significantly lower than the prior close. Typically, the price continues moving in the runaway gap direction within a few weeks and sometimes within days or even the next day. A runaway gap doesn't need breach a major support or resistance level like a breakaway gap, but it must occur in the current trend direction. As a trend nears its end, it may experience an exhaustion gap. An exhaustion gap occurs near the end of a trend and is caused by the final group of buyers who regret not having bought prior surging in. In a downward trend, an exhaustion gap is a gap caused by sellers. An exhaustion gap is similar to a runaway gap, except that the exhaustion gap is usually associated with the very high volume. Some runaway gaps are as well, yet traders can also watch for exhaustion gaps to fill quickly. Since the exhaustion gap usually occurs near the end of a trend, any progress the gap made is usually erased. Gap filled within weeks and often within several days. There are also common gaps when there is a small difference between the opening and closing price. These occur frequently, and most traders consider them to have less significance than the breakaway, runaway, and exhaustion gaps. To fill or not to fill. When someone says a gap has been filled, that means the price has moved back to the original pre-gap level. These fills are quite common and occur because of the following: irrational exuberance, the initial spike that may have been overly optimistic or pessimistic, therefore inviting a correction. Technical resistance, when a price moves up or down sharply, it doesn't leave behind any support or resistance. Price patterns. Price patterns are usually classified gaps and can tell you if a gap will be filled or not. Exhaustion gaps are typically the most likely to be filled because they signal the end of a price trend, while continuation and breakout gaps are significantly less likely to be filled since they are used to confirm the direction of the current trend. When gaps are filled within the same trading range on when they occur, they are referred to as fading. For example, let's say a company announces great earnings per share for this quarter and gaps up at the opening, meaning it opened significantly higher than the previous close. Now let's say as the day progresses, people realize that the cash flow statement shows some weakness, so they start selling. Eventually the price hits yesterday's close and the gap is filled. Many day traders use this strategy during earnings season or at other times when irrational exuberance is at a high. How to play gaps. There are many ways to take advantage of these gaps, with few strategies more popular than the other. Some traders will buy when fundamentals or technical factors favor a gap on the next trading day. For example, they'll buy a stock after hours when positive earnings is released, hoping for a gap up on the following trading day. Traders might also buy or sell highly liquid, illiquid positions at the beginning of a price movement, hoping for a good fill and a continued trend. For example, they may buy a currency when it's gapping up very quickly on low liquidity and there's no significant resistance. Will fade gaps in the opposite direction once a high or low point has been determined, often through other forms of technical analysis. For example, if a stock gaps up on some speculative report experience, traders may fade the gap by shorting the stock. Lastly, traders might buy when the price level reaches the prior support after the gap has been filled. An example of this strategy will be outlined below. Here are the key things you will want to remember when trading gaps. Once a stock has started to fill the gap, it will rarely stop because there is often no immediate support or resistance. Exhaustion gaps and continuation gaps predict the price moving in two different directions. Be sure you correctly classify the gap you are going to play. Retail investors are the ones who usually exhibit irrational exuberance. However, institutional investors may play along to help the portfolio, so be careful when using this indicator and wait for prices to start to break before taking a position. Be sure to watch volume. High volume should be present in breakaway gaps, while low volume should occur in exhaustion gaps. The bottom line: those who study the underlying factors behind a gap and correctly identify its type can often trade with a high probability of success. However, there is always a chance that trade will go bad. You can avoid this first by watching real-time electronic communication networks, ECN, and volume. This will give you an idea where different open trades stand. If you see high volume resistance preventing a gap from being filled, then double check the premises of your trade and consider not trading if you are not completely certain it is correct. Secondly, be sure the rally is over. Irrational exuberance is not necessarily immediately corrected by the market. Sometimes stocks can rise for years, extremely high valuations, and trade on high rumors without correction. Be sure to wait for declining and negative volumes before taking position. Last, always be sure to use a stop loss when trading. It's best to place a stop loss point below key support levels or set a percentage such as -8%. This indicator works in a variety of markets. It is a very powerful indicator. We combine this indicator, gaps ups and gap downs, with other indicators using a weight of evidence. One indicator does not make a successful system. Not one gap up or gap down should be relied on by itself. Please watch the videos on top-down strategy, my investment strategy, and CCI indicator to help combine gap ups and gap downs to make a rule-based strategy. You know the catchphrase: study it, analyze it, adapt it. Peace.